Welcome back to the ET Money Show, and now we have a very interesting discussion lined up, and this is about FDs and debt mutual funds, because if you see both these assets, then they are the most popular assets for the risk-free investors, wherein FDs have proven to be a reliable option for the Indian retail investors, whereas if we talk about the investments in the debt side, then the mutual fund way has been opted well by the retail investors as they invest in debt securities. But the question is that if they have similar risk profile, which one gave the better returns in 2022? We are going to draw a comparison on that, and apart from that, what are the factors that you should be looking out for while choosing between those? So let's try to rewind 2022 and understand which one was the better yielding investments, and when we have been fighting with inflation, interest rates and so on, going forward, which can be the better one out there. So let's start the discussion on FDs versus debt funds. And today we have a very special guest joining us in the studios, Mr. Vijay Mantri, who is the Chief Investment Strategist and co-founder at JRL Money. Thank you so much and very good evening, and pleasure having you onto the show. I think you don't often come to our studio, so it's a surprise visit, isn't it, Vijay?
Very kind of you to invite me, and my office is next door, so that temptation I could not stop. But first of all, very warm welcome to your viewers, and hope happy post-Merry Christmas to all of them, and Happy New Year in advance.
Well, yes. I hope the markets also were in a very cheerful mode today indeed. But let's cut straight to the topic today. We keep discussing about debt mutual funds and FDs. And in India, these two asset classes go hand by hand in terms of the risk side of it. They both are considered to be somewhat risk-free in terms of returns. But talking of the returns perspective, how do you compare 2022 for the debt mutual fund and FDs in terms of returns?
So if you look at total asset under management and debt mutual fund, it is around 14 lakh crore. And if you just take out target maturities fund and Bharat bond, then 95% asset remain in liquid and ultra short duration funds. So the mutual fund industry done a fantastic job in communicating to the investor that stay invested in the shorter duration of the curve, because interest rates are rising. So in my opinion, significant alpha addition has been done. And one of the biggest things they have done is to protect investors' wealth in 2022. And if you look at FD, which I believe gave close to 5.5% return, most debt fund comes closer to that. But that is just one half of the story. The other half of the story will get played out in 2023, as we discuss in the show in next few minutes.
But talking of 2023 story, Vijay, we know that interest rates are on the rising trend going forward, because that affects the bond yields as well, so to the debt mutual fund returns. And for the FDs, the expectation is on the higher side, but we are still behind the curve in terms of the kind of interest rates hike we are seeing and what FDs and banks are offering. So keeping that in perspective, what is your take, which can be a better bet for 2023 for the investors?
So you're absolutely right. When the interest rates are rising, banks FD interest rate rises, but with huge lag effect. They rise not to the same quantity, and it takes lots of time to come to the same level. But if you look at the same bank CD, 1 year CD, it has already gone up 300 to 400%. So for instance, if you look at 1 year back, the bank CD was 3.43, 1 year bank CD was 3.5%. Today it is 7.5% to close to 8%. Same bank, the FD is 5.5% to 6%. So where you going to get 7.5%, 775? That option is available in the debt mutual fund. So yes, banks are slower, even RBI is slower, but the market anticipate all these things in much advance. So for instance, if you look at 10-year GSEC, it peaked at 760 few months back. Now it is trading at 720, 730, 740. So the markets run ahead of what even central bank intend to do, or what even the banks intend to do. So in my opinion, if you look at, for instance, look at plain call money fund, where the banks mutual fund invest into the RBI, that call money rates around 6% plus. So even if you want to invest for 1 day, you want to invest on Friday and take money out on Monday, it is 6% interest rate available to you without any risk, because it's lending to RBI. And if you just go beyond that, if you look at 7 days, 30 days, then you have liquid fund available, while YTM is 6.5%. If you look at similar maturity FD, it is 5%. The longer you go to 1 year, 1.5 year, and 2 year. If you look at AAA bond or 3 year or 5 year bond, they are at mouth-watering yield level, 7.5%, 8%, 8.5%. So we believe 2023 will be very, very good year. If you are a debt investor and if you want to participate in debt mutual fund, is a fantastic option. And why should do it? Forget about the gross yield. Now look at the net yield, the taxation. Suppose you look at FD, you need to pay tax on FD every year, whether you take money out or not. Now just think as an individual, you pay 10%, 20%, 30%, 37 and 42% tax depend on your tax slab. After that, you pay 20% consumption tax on an average.
Yes.
After paying all these two, where you don't have any choice, why you still want to tax your money by investing in fixed deposits? I just don't understand. So I think this is the right time investor need to move toward investing in the debt mutual funds.
Okay, but Vijay, you did touch upon the taxation part, but other than the returns and the taxation, any other factor that you feel like why people should look into the debt side of the business and not FDs?
So one is the professional management. As I told you, in 2022, every mutual fund house said that is stay invested in the short duration. So professional management not only comes into portfolio construct, but advising in what kind of duration one need to invest. The second thing is diversification. If you invest in 5, 6 debt mutual fund, you invest 100 to 150 securities. That is the second point. The third point is power of compounding. So I'll just give you illustration. A 10-year tax-free bond, suppose you invest 10 lakh rupees in 10-year tax-free bond, you get 1 lakh rupees interest every year. So in a 10-year period, on a 10 lakh rupees, you got 10 lakh rupees interest. So you feel like you have a 10% return. But in debt mutual fund, the 10 lakh become 20 lakh only if it compounded 7.3%. Because the tax-free bond yield get vested in the client's account. It doesn't get used. But in debt mutual fund, the incremental cash flow get reinvested at same yield. So it offer you better power of compounding. There's a one part. The second part is holding period return, which many investors do not understand. So for instance, suppose you are doing FD of 365 days. You don't need money on 365th day. Perhaps you will need money on 13th month, 14th month and 15th month. What you do, you generally do FD for 1 year, and then after 1 year you do FD for 30 days, 90 days. In a debt mutual fund, for instance, your horizon is 1 year, invest in money market fund. Suppose you invested 50 lakh rupees in money market fund. After 1 year, you just need 5 lakh rupees, take 5 lakh. 45 lakh rupees will continue to earn the yield of at that particular time period. So holding period return is far, far superior. I have done a study. If somebody has to compare data for last 25 years, we have data for 25 years in debt mutual fund industry. The longest debt mutual fund in India has compounded investors' wealth at just below 9% for 24 years.
Wow.
Yeah, and it competes with equities. Really?
Absolutely, because in such a long period of time, if you are seeing such stellar returns, I think that's commendable. And I think then this asset class has been undervalued.
Exactly.
Right?
Not forget about it. It has not been represented in the client portfolio. So the oldest gilt fund started in December 1998. So it complete 24 years. In a 24 years, if you compound investor wealth at 9%, is amazing number.
And that too in a risk-free asset.
Not you are investing
free,
in government.
like,
is a risk-free? Absolutely.
Yeah.
There's no credit risk. Only thing you need to keep in mind, stay invested for the long term. So I have analyzed, for instance, I have analyzed tax-free bonds. Okay. There were 264 tax-free bonds invested in India. I analyzed one corporate debt fund. That corporate debt fund has outperformed all these tax-free bonds. It's an incredible number.
Absolutely.
So, in my opinion, what we have seen in 2001, 2002, or what we have seen in 2013, where the yield has moved up, 2023 is a great year. Don't lock in your money into bank FD. Move that money into debt mutual fund. If you're scared, invest in liquid fund, invest in money market fund, because even liquid fund has compounded wealth at 7% plus for 20 year plus. A liquid fund product. So forget about money market and gilt fund, but it is the least understood investment vehicle available or made available to Indian investor. In equity, you have a choice. You can go for AIF, you can go VC, PE, stock advisory, PMS, mutual fund, director stocks. In debt, actually, there's no option other than that, other than debt mutual fund. And I do not think mutual fund industry done a good job of advocating. I have done so much study on recurring deposit versus debt mutual fund SIP. Actually, it is a no-brainer. In a 5-year time, a debt mutual fund will deliver you 20 to 30% more return than bank FD. In a 10-year period, 100% more than bank FD. In a 15-year period, 200% more than a bank FD. In a 20-year period, 300% more than a bank FD. And please remember, your FD is not for 3 years. The FD investments are for 30, 40 years, because what do you do after 3 years? You renew the FD.
And this amount is kept there and
Kept
gets
there.
renewed by the bank itself.
And look at the amount of money, 37,000 crore in saving accounts, giving you 4%. Overnight rate is 6%. So if you just apply 2% on 37 lakh crore, Indians FD investors are poor by, to that extent, only to the saving account around 75,000 crore. And if you look at 48 to 50 lakh crore of bank FD of Indian household, a debt mutual fund outperform bank FD by 70 basis point to 1.5%. Apply that number. And I'm talking about without taxation. I'm just saying on the gross basis. So it is, for me, is a mystery why more people are not investing in a debt mutual fund. And I hope this year it will change. It should change.
Absolutely, we hope too, because I think this is a mind-boggling number that all the investors are looking out for there. But Vijay, you did touch upon which category of debt mutual fund was actually recommended, because I also remember that some time back when there was the bond yields were actually cooling off from those high levels, maybe the shorter term duration funds were recommended. But going forward in 2023, which category of debt mutual funds is something that investors should look
So
for?
debt mutual fund is like equity investing in 2004 currently. So you invest anywhere, but invest. You invest in liquid fund offering you 6.5%, which is 7 days to 30 days. A money market fund or ultra short term offering 7% plus. A credit fund is YTM is 8.5%. Incredible number. And it compounds at 8%. People don't understand the difference. So a client of mine who told me that I have this 10% Tata NCD available in international market for 10 years. I said, but will you compound wealth at 10%? You will get coupon at 10%, but at what rate you will invest that coupon? You need to ask that question. Your FD, your NCD, your tax-free bond, the interest coupon you get doesn't get reinvested. And if you look at longer time duration, 90% of your wealth is return on return, which you miss out when you do tax-free bonds. You look very smart. I did 10% tax-free bond. I did a study. It doesn't cut ice, unfortunately. But people are, I don't know. I hope things should change the way it changed in mutual fund industry in year 2000. I think it should change around this time.
Well, yes, absolutely. We hope too, Vijay, and thank you so much for today joining us on ET Now Studios Live and helping our viewers have this crazy stats on how debt mutual funds have outperformed FD's returns in past so many years, and that's a sure shot money that is lying there,
Absolutely.
but people are not utilizing that stuff. But maybe 2023 year
So I'll just add one thing. If
Please.
one of the very good way, I'll take just 30 seconds to explain. One of the very good way investor can create substantial wealth using debt mutual fund is invest money in a debt mutual fund. Whatever gain you are getting, transfer that gain into equity mutual fund. This way, not only you're protecting your capital, but in a very calibrated manner also participating in equity market. So use that strategy if you're scared of the market, and also create wealth through debt plus equity combination.
Well, yes, that's a mantra for wealth creation, as well as how could you play with your allocation, but with